And if you look at the markets at that point in time, you saw massive volatility during that time. And any deviation in the price of crude will end up affecting the fiscal deficit for India. I don't like the whole idea of bracketing yourself as a value investor or growth investor.
Hello, Federal viewers. Thanks for joining us. Today we have with us stockbroking expert Sagar Lele, and he's worked with some big names like Deva and Motilal Oswal. And then he started his own startup, which is Repeating today, which has merged with Patterson Securities, which is one of India's oldest broking houses. So join us today on a talk which will tell you whether you need to invest in mutual funds or invest directly in the market. Hello. Given what happened this year with the conflict with Pakistan and then the Iran-Israel conflict, do you think domestic investors should be scared when it comes to geopolitical tensions as to how they invest in the market?
So any market globally does react to conflict. So what eventually happened was that the globe entirely faced a big bout of inflation because of this conflict, which took a lot of time to recover from. When it comes closer to home, the conflict is when you actually see an impact. So with India and Pakistan, for example, it is very close to home, and if you look at the markets at that point in time, you saw massive volatility during that time. So I wouldn't say India is shielded from the economic shocks. It is very much prone to it. However, it depends on the nature of conflict and how much it affects us. In a lot of cases where crude oil directly gets affected, India is very, very highly affected because India is a major importer of crude oil. We get most of our crude from outside, and any deviation in the price of crude will end up affecting the fiscal deficit for India. So when crude shot up even during the Iran-Israel conflict, suddenly there was a lot of tension about how we'll deal with inflation, how we'll deal with the rising prices of crude, and hence how will we manage our economy.
Earlier, you saw FIIs. There was this fear in the market that with FIIs leaving, then the market might crumble. But today you see resilience because there are a lot of domestic investors. So today, what should the normal investor look at when they're investing?
So when it comes to conflict, I think normal investors should ignore it. They should continue their SIPs because that creates some amount of discipline. We've seen that historically in modern conflict, whenever there has been an issue, we've come out of it pretty well. What the retail investor should focus on is how do we make the most of these conflicts. It sounds very capitalistic, sorry, but how do we make the most of this conflict? How do you take opportunities out from the market downfall? Use the volatility to get your stocks at a lower price and hence make the most out of your money. Because at the end of it, if you're able to buy these stocks at cheaper prices, which these opportunities do offer, then that's when you'll make money when the market normalizes.
Do you feel that the person who's investing directly in the stock market already has a high enough risk appetite?
It depends really. Some of them come into the market or start directly investing because they want to try it out. One of the most unfortunate events has been post-COVID, the market rally. Unfortunate because, I mean, market rallies are great, everybody loves them, but the point was that anybody who entered the markets during 2020 and 21, and there was a lot of people that entered the markets during that time, everybody ended up making a lot of money over the next 2 years. So it resulted in a false sense of knowledge, a false sense of expertise amongst investors that I know how to invest, I know how to make money in the markets. And that is the risky proposition, right? Because when the markets do not really go one way in a bull run, and when things become a little more difficult, is when you start seeing losses combine. And we've seen that after 2021. The end of 21, it was great until then, but 22 and 23 were pretty rough. And that's when I think a lot of the investors got their reality check. So I'm sure people want to invest directly by themselves, but it, according to me, is not really a thing for everybody. It's more like a full-time job because it requires a lot of research. It requires a lot of investment in terms of time and effort. And if you've got a full-time job already, might as well leave this activity to experts. Because you're not going to be able to match up to, for example, we've got a team of 10 fund managers and research analysts. An individual is never going to be able to get even close to us when it comes to the combined experience that we have.
What would you say when it comes to growth versus value? Because I know that, for instance, my father would prefer like a blue chip stock like SBI or something, whereas when I invest, I would like to go for a small cap like Muthoot Finance because it would, like, in terms of value, the exponential growth, 2x, 3x that you're seeing, the increase in share price. So that way, like, how would you ask people to invest in small caps versus blue chips? And also, how much is age a factor when it comes to investments?
So I wouldn't classify strictly. I mean, I don't like the whole idea of bracketing yourself as a value investor or growth investor. That to me does not really work throughout cycles for markets.
Okay.
There are times when you need to be a growth investor. There are times when you need to become a value investor. And a good example is the last 5 years. If you look at post-COVID 2020, you could be a growth investor. Everything was picking up. Value didn't really make money. For a period of 2 years, you made immense money in growth versus value. However, the time came after that when markets got a little tough and became a little more range bound, is when value started making more money than growth. And that will change again.
When it comes to age, what would you say is the right age to have a mix of 60% equity and 30% debt? Would it be in your 20s, 30s, or 40s? And should your risk appetite go down the older you get?
So one is that age is just one factor in determining the proportion of equity versus debt. One needs to consider a lot more factors than just age. So when it comes to age, what we do as a thumb rule for our investors is that 1 minus your age should be the amount of equity proportion you should have. However, that's the baseline. You start there. That's not the end game. You start there. So for example, a person is 30 years old, they should be investing about 70% in equity. However, if they are conservative investors or they are risk averse, they should probably tone it down from 70 to maybe 65, right? If, for example, they are long-term investors and they don't want to see the money for the next 30 years, they can probably notch it up a bit. So it depends totally on factors like how much money you are planning to spend, when do you require the money, what is your risk-taking ability, what your job is, for example.
India, most people are familiar with mutual funds and yes, maybe to some extent, equities. But what about the treasury and the, corporate bond market? Can you tell us where a retail investor can see growth in that?
So the bond market, to be honest, we were gung-ho on the bond market till some time back, till the interest rate cycle reversed. So till a few months back, in fact, we thought that bonds, long-term bonds especially, it was great to lock in the high interest rates at the place they were. And then you've seen about 100 plus basis point cut in terms of the RBI monetary policy and the repo rates. So from here, we think that bonds may not be as lucrative as they were a few months ago. But in any case, it's about balancing your portfolio out and you need some exposure to debt. The easier way rather than doing corporate bonds directly is to just invest in debt mutual funds. You've got so many options. You've got government bonds, corporate bonds, you've got different ratings of bonds. You've got a mix of bonds as well. So it just makes sense to let the fund managers take the call rather than doing it yourself.
Some people, they use algorithmic trading and, the likes of Zerodha and all lets you set your own limits and, how you want to invest. So one of the examples I heard, and this is of course an expert, he works at a broking house, but what he had done is he had equated Google Trends. So he said, what are the maximum searches running? And one of the companies he found was like these NBFCs. And so he decided, okay, like people like Muthoot Finance, they're like, among the top searchers because maybe people want this. So he made his investment strategy equated to Google Trends. So like that, there are people who, feel that, okay, maybe this is how I should like place my bets on the market. What is your take on that?
It's a good start point again. So for example, since we spoke about conflict and wars, it's a great example where it's pretty obvious that defense companies will do well. Because Google Trends will also show that suddenly defense companies are talked about, arms and ammunition are all over the news. You're talking about US also imposing a certain limit on or a certain floor in terms of how much all the countries are spending on defense. So from that aspect, I think it's very intuitive that defense companies will do well, right? However, from a stock market perspective, I think you need to go a little deeper rather than just looking at the trend. We like to look at these trends, but the stories should also make sense at the end of the day. So I'll give you an example. Right now, defense companies, if you look at the returns over the last 3 to 6 months, phenomenal, especially post the war. Just chart out any defense company post the war, you've seen that they've done phenomenally well. However, everything comes for a price. Similar is the case for stocks. Valuations do matter at the end of the day. You can't buy something supremely expensive just because it is trending, because at the end of it, it will also come down. So at this point in time, for example, in the defense space, we are positive on the overall space, but we've just, if I have to buy some defense company right now, it'll just be a couple of companies that are on my radar. I would ignore all of the rest right now. What I'd do as an approach is I'd make a bucket list of the companies that I like. And whenever these stocks fall to levels that are comfortable to me, I would start investing in them. So I think trends are great to follow from an ideation perspective, but from an execution standpoint, you have to rely on some more research like financial performance, valuation, triggers, and then come to a holistic decision about whether you want to invest or not.
Does India have the possibility of like more complicated, like because the 2008 crisis was because of the subprime market and it was due to derivatives trading, or even Nick Leeson, when Barings Bank went bankrupt because of his trading, it was because of a very complicated derivatives market where like nobody knew where the money was going or even how these valuations are being arrived at. So do you think that risk exists for India, or we are only going to see like Harshad Mehta type scams?
I think risk is there in the market and we've seen it time and again, right? We've seen scams, we've seen individual companies go bust also. We've seen something like an Ireland FS also happen. So India's weathered the storm when it comes to any of these crises.
But what about the complication? Do you think our market itself could become more complicated?
See, everything has a ripple effect. At the end of it, there is one big piece going down, it will have a domino effect on the others as well. If you look at Vodafone Idea today, for example, why is the government going all out to save it? At the end of it, you see that, of course, one is that Vodafone Idea has a lot of government dues itself in terms of spectrum dues and AGR charges and all of those things. However, if you also look at Vodafone Idea, it's got a lot of debt on its books. If it is not able to repay that debt, you will have a lot of banks going into a crisis zone. So to save such things from happening, I feel the Indian government and the regulatory bodies are very, very proactive in terms of stepping in at the right time. We still can have multiple companies go down and they will survive, they will not survive, they will maybe make a comeback, maybe not. But at the end of it, I think the way I look at it is that you need to be a little more prudent when it comes to your stock selection. Maybe avoid companies that have corporate governance issues altogether. Stay on the safer side. If you know that some companies are sketchy, or
like Gensol.
yeah, or they're in the news for being sketchy, or there is some fishy activity happening, you might as well not invest in it. The other thing also happens is that sometimes you get great opportunities out of these things as well. So I'll give you an example. Ireland FS plus some corporate governance issues. There was a company called India Wools Housing Finance, which was one of the top 3 lenders in India, had crossed a 1 lakh crore AUM and all of that. However, that also started to take a massive hit. Now what happened is that that company, there's a private equity investor that has come in. They've rebranded to Samman Capital. What they're doing is they're trimming down on their old loan book massively. They've already cut it down by about 60%. At the same time, they're making a new loan book which is much more fresh, prudent, more conservative, more growth oriented. And that loan book is now a major portion of their entire book. So this is a name which went down, got acquired by private equity investors, and now is making a comeback as a different company with fresh management, fresh leadership, fresh promoters. So sometimes you can get these ideas as well in the market, take advantage of some downfall and actually make money on the upside.
Got it. And say this person is more risky. They're not just looking at equities. What if they wanted commodities or currency trading? Then what would your advice be?
Currencies and commodities tend to be more cyclic in nature, commodities especially, and you've seen that with, I mean, gold is a little insane right now. Very hard to understand how it never stops rising. But however, commodities are very highly linked to inflation, right? If you look at the usable commodities or metals, for example, they go through their own cycles, oil, metal stocks, etc. All of them go through very large cycles. Commodities make a lot of money if you're always playing them in the short term.
Okay.
So if you pick them up at the bottom, sell them at the high, if you're actively trading commodities, you're able to make money. So commodities and currencies are a great way to sort of diversify your portfolio, sure. But are they good strategies to hold on to for the long term forever? Not really.
So if someone wanted to trade in crypto or trade outside the Indian market, then what would you tell them?
See, anything that is on the sidelines when it comes to regulation or in a gray area, just avoid. Right? Tomorrow,
so you would say no to crypto?
I mean, I'm all in for crypto, but the government should be on the same page as well. So when the government is regulatory on a regulatory basis fine with it, I think I'd jump in as well. But if there is a regulatory gray area, I would completely avoid it. So from a crypto standpoint, although I love the idea of crypto, and I think it's going places as well, because US banks are also now allowed to be dealing in crypto, for example. So it is a growing market. It is getting more acceptance as we move forward. But I'd wait for India to gain acceptance as well before jumping in on that trend. When it comes to international equities, again, there's two viewpoints, right? One is what you got to think about is if there are 3,000-4,000 stocks available in the Indian markets, do you really need to step out and get exposure to international stocks? Sometimes when Indian markets are going up, the US market will be going down or the other way, so it'll just buffer your portfolio overall. So international exposure is great. You can do that through mutual funds or ETFs. I think that's a great idea because it's also low cost. However, if you were to pick individual stocks in the US, there is a lot of paperwork, there is a lot of transaction cost. So all up for international equity. However, I think it's better done through easier and low cost means and with low effort. So it all points down to a few mutual funds and ETFs on the international side that you can pick up.